1, 2, 1, 2, 1, 2. Just testing this, just testing. Sometimes I just test again because sometimes you lose the work if you don't. Right. So the carrying on part 3 of this. Carrying on, we're looking at the purpose of the framework. The purpose of the framework. So the conceptual framework published by the board is called the Conceptual Framework for Financial Reporting. And again, like the key point here is that it's giving guide. I mean, fundamentally, right? The whole point of this is to enable financial reporting. We will discuss very quickly the qualitative characteristics. So what is considered to be the qualitative, the underlying qualitative characteristics, right? What must every set of accounts take into account when set of financial, the reporting of any financial accounts, what must they take into account when putting their accounts together? We will look at, it also guides us with the definitions of certain elements. So what's an asset, what's a liability, what's income, what's an expense, what's a provision. You see where I'm going? All those kind of things. When do we recognize them? When do we derecognize them? How do we measure them? How do we change the policy? And this discussion of capital and capital maintenance that we'll see in the next chapter. The question of capital maintenance is very much about trying to get the real value of those assets and liabilities. Really, this is to do with relevance. You see, well, again, to do with relevance. And again, like I say, to ascertain, because we're trying to get this as current or useful to users. So it's all well and good to keep things historical, but if it's no longer relevant, then we have a problem. But also to take into account things like inflation and to make sure that the company that we're dealing with here is aware of the real changes in events and takes that into account, so that you don't go out, pay out a dividend, and you're not able to carry on trading because your money has lost its value, or what you have left cannot purchase the same quantity it could prior to at the beginning of the year because you didn't take into account those inflation losses, right? And that's kind of what this is trying to approach. So the standard gives guidance on that as well. So the purpose of the framework, of course, is to assist the board, making sure the concepts are consistent, developing consistent accounting policies, especially when there's no standard, if you like, where we don't have a standard, or where a standard allows for a choice of accounting policies. And we all want to be able to understand and interpret the standards. Key point here is the framework itself. Again, like you say, we've had IASs for a while. Of course, we have IASs. And in those, we have we already discussed those elements and represent events within those elements. And then we now have the IFRSs, which are coming in, right? And then now we have the conceptual framework, which is trying to kind of help clarify a few things here and there and be a bit more structured with the definitions. But in itself, the framework itself is not a standard, right? It's just a guide or a structure around these definitions of these elements. And so ultimately, the key point here is in any rare instance where there may be a conflict between the framework and an IFRS standard, the requirement of the IFRS standard prevails over the framework. So what's in the framework is critical to ensuring that, what's in the standard is what we really go with, right? That's our aim, to really go with the standard, but of course reference the conceptual framework. Again, I've said it several times, we're trying to ensure that information is balanced and useful for existing and potential investors, lenders and creditors, as they seek to make decisions about providing resources to the entity. So key and critical, really, the fundamental qualitative characteristics, the fundamental underlying qualitative characteristics, which are important, you must know, this business of relevance and faithful representation. Relevance, should it be there? Should it be in there? Will the omission of this thing mislead an economic user? What is the most up-to-date sort of expression of this thing we're talking about? How will it best aid the decision making by the user? Should we be using fair value instead of historical cost? Using historical cost, would that mislead the user? Is it material? Is the question, the thing we're talking about, should it be included, if you like, in there so that the user can make a good decision? So that's really this question of relevance. Faithful representation is about substance. What is the substance of the transaction, if you like? Is everything there? It's like telling a story, isn't it? It's like someone says, give us an account of what happened, right? I mean, are you objective? Have you told us the full story? Is it free from bias or error? That's what's going on here with faithful. Tell us the events as they happened, not tell us what you think. Tell us the substance of what happened, as opposed to saying, well, Anyway, then we have, of course, the enhancing qualitative characteristics that we've always talked about. Comparability. We want to be able to compare financial statements from one year to the next, of course. Verifiability. We want things to be on time, very much connected to relevance there, and we want people to really understand what's going on. Then, of course, we have this kind of underlying assumption. It's not really about characteristics. It's just sort of saying it's like talking about life. Really, you must be alive to even discuss the events that happen in the world today. So you must be a going concern for us to even start applying these fundamental concepts and these to apply that. You must be a business's going concern. You'll be here for the foreseeable future. If that isn't the case, well, then you need to prep your accounts based on a different basis, which must be disclosed, right? And that's kind of the point there. Relevance. Let's talk about relevance. Information is relevant if, again, like I say, it has the ability to influence the economic decision of users and is provided in time to influence those decisions. So we're talking about timeliness. We're talking about will the omission, so materiality, will the omission affect the way the user will behave or act? So information provided by financial statements needs to be relevant. And again, here, when we say relevant, people can make judgments, future decisions, predictive, or can confirm that's what it is. So it must have that kind of, I can make a future decision based on the information I'm seeing right there. I mean, that's why it's relevant, right? So which is why I talked about fair value or a revalued amount for property as opposed to its historical account, its historical amount. Historical, thank you very much. That's exactly what it is, but I need to make a decision. So, yeah, I think that's kind of those are the key points. This question of predictive values and confirmatory values. Again, here, if you have a number of options, what we're trying to do again, where you could recognize something for, we have a number of options, is to go with, of course, the maximum relevance of that information. Yeah, the one that would be of most use when in taking economic decisions. Again, materiality is critical. Again, is it essential enough to be included? I mean, if it isn't, then we can omit it. We don't have to include it. But materiality is an entity-specific aspect of relevance and depends on the size of the item, if you like. So threshold quality, very much connected to relevance and whether or not the omission would matter. So typically, this is a matter of judgment. So the preparers of the accounts must decide whether or not they feel something is material enough. So we have a cut-off point. If any information doesn't pass the test of materiality, it doesn't need to be considered further. So it's very much about them sitting there and making a decision as to whether or not they feel that is material. Faithful representation, I sort of hinted at that already, this question of substance, this question of the economic reality, this question of the full account of what actually happened. Is it free from bias? Tell us objectively what's going on. Is it complete? Have you told us everything? If you like. So we want for information to be faithfully represented. It should possess all these characteristics. And we talk about also being free from error. Again, neutrality, objectivity, free from bias, and of course free from error. Now, of course, with error, when we talk about error, let's be clear, we're not talking about perfect. If you're having an estimate, you can't have a perfect answer. So it's not about, I'll give you this perfect answer. No, it's very much about, okay, you've done the best to get a good enough estimate, and we can accept that based on your good judgment. So error isn't numerical per se. Error is, if you like, an arithmetic error or even error due to fraud, that sort of thing. So again, like I say, yeah, this is what I was saying. It's not about perfection, but it's about making sure you're good with the estimate. Right. Okay. Great. So that gets close enough to 10 minutes. And what we'll do is we'll come back in the next video and discuss enhancing characteristics we talked about there: comparability, verifiability, timeliness, and understandability in the next video.